I'm not an expert in the development issues that I discussed today. Nonetheless, as a frequent investor in small and mid-sized companies in emerging markets, I would like to briefly share with you the approach of 4B. 4B is a wealth management company which focuses solely on social and environmental impact investments. Impact finance is the notion that financial investing can and must create social and environmental added value, which in no instance can be disassociated from financial returns. And vice versa, financial returns have no value or meaning if not blended with a measurable impact. This added value can be achieved only in the long term and must be sustainable. For many parts of the globe, resources, whether financial, human, or natural, are scarce. So it seems that sustainability can be maximized only through efficient uses of these resources. If emerging market countries are really to be the winners of the 21st century, as many believe, then striving for efficiency must be embedded in everything that is done. At 4B, we are driven by the notion of interconnectivity. No single activity or sector or industry is able by itself to create value to achieve sustainability. To elaborate this point of view, please allow me to use the example of the microfinance industry, and this for two reasons. One, I have spent 10 years on the board of directors of a microfinance institution active in over 20 developing countries. I have witnessed the wonderful work achieved, but I also was able to see the inefficiency of this industry in its quest to alleviate poverty. Two, there has been so much focus and hope put on this industry that it provides a wonderful case study in sustainable impact or lack of. Microfinance is simply the provision of financial services to the poor. The outreach and the scalability of these services have been outstanding. MFIs have proliferated, some have been quoted on stock exchanges, and there has been creation of wealth for several key actors in the industry. But if we look at the impact of microcredit in the quest to alleviate poverty, the results are in no way outstanding. People stay at the poverty level because surrounding infrastructures are deficient. They do not readily have access to education, health services, and poverty. As such, sustainability is not achieved. Today, there is a strong risk that the microfinance industry will, because of a huge and relatively quick inflow of capital, experience a breakdown and go through the inefficient cycles experienced in developed markets. Why such a sudden inflow of funds? For the finance-first investors, it is the perceived decorrelation to other markets. To the impact-first investor, the belief that vast amounts of funds need to be allocated to this industry for it to be able to eliminate poverty. Is this inflow of funds efficient? Absolutely not. So as an investor searching for impact, I cannot be satisfied with a microfinance investment alone. Microfinance is but one element in the value chain. Where can I invest to bring leverage to the microfinance investment I have made? In my opinion, an investment strategy incorporating, in large part, support to small and mid-sized companies will reinforce this value chain. How can governments contribute to the strengthening of the value chain? Enable the proliferation of small and mid-sized companies that will greatly improve the economic environment and the infrastructure of a country. Very quickly, besides the need to limit bureaucracy and increase transparency and provide a simple and easily understandable legal framework, three aspects of government contribution come to mind to enable the proliferation of small and mid-sized companies. Incentives, taxes, and subsidies. If we assume that sustainability equals innovation, and that innovation is vital for competitiveness, then there should be incentives for sustainable business practices within these companies. Simplicity in taxation will motivate and, more importantly, enable companies to increase tax revenues for governments. And thirdly, subsidies, when allocated to prepare the breeding ground for the inflow of private capital, can prove to be extremely efficient. In summary, if emerging countries are to be the winners of the 21st century, then governments must maximize sustainability. Since all components of the value chain are interconnected, then resources must be allocated across the board. From my point of view, small and mid-sized companies are key to an efficient, prosperous, and sustainable economy. Thus, everything must be done to help the creation and growth of these companies. Thank you.